Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Lieutenant Colonel Tony Bancroft, Portfolio Manager of the Gabelli Commercial Aerospace and Defense ETF, ticker symbol GCAD, GCAD. We're talking about the outlook for the aerospace and defense industry in 2026, especially after a blockbuster year in 2025. And Tony has a fascinating background. He previously served in the United States Marine Corps as an FA-18 fighter pilot. So Tony, before we start, thank you for your service and great to have you with us today.
Yeah, it's great to be here, Neena. Thanks so much.
So let's start with the European defense stocks, which had surged last year. They, in fact, outperformed the US defense contractors because European governments were ramping up military spending, and that was partly in response to President Trump's pressure on NATO members. He was telling them to spend more on their own defense. And you actually recently published a note. It was an interesting note, and it talked about common misunderstandings around how NATO alliances are actually funded. Can you walk us through that?
Yeah, I mean, I think it was a strange article. I don't know if you saw the article in Reuters, and it was trying to it was sort of like not a myth buster, but it was I think they were trying to say they're clearing up confusion or there's misunderstanding about defense spending. And it was I when I read it the first time, like, is this it didn't seem like it made a lot of sense, because I think it was thinking that people were confused about how the NATO budget, sort of the NATO budget for keeping the lights on, sort of the basic operations of NATO, which is, relatively, it's de minimis relative to, global NATO member defense budgets. And just sort of saying the US is not really that big of a participant in NATO defense budgets. And it's just, I don't think they're trying to be misleading any way at all, but it was just, I don't think, I think everyone generally understand, at least everyone probably in the aerospace and defense industry, or the defense industry, excuse me, is pretty clear that when the people talk about defense spending, they talk about, countries, sovereign countries' defense budgets, and the target being 2% and now going to 3.5%. And on top of that, up to 5% if you're including infrastructure and support elements and all that. I think that's pretty clear. And if that's the case, the U.S. is, by and large, I mean, it's really, it's multiple orders of magnitude more than the rest of NATO as far as how the U.S. supports NATO. It's really the gorilla is the U.S. and there's everything else, that sits around it. And so I think that was sort of the genesis of that report. I just sort of want to make sure everyone, fully understood that, it's pretty obvious that NATO is, the vast majority of defense spending in NATO is it's like 1.6 trillion or whatever it is this year, and 6 or 7 trillion. And of that, the U.S. is essentially $1 trillion of it's, almost $1 trillion is about the U.S. Right around there. So, I mean, that's just the math. Anyway, I think that's just the general concept of that report that you mentioned.
So these European countries have been boosting their defense industries, mainly in response to Russia's war in Ukraine. And that was even before, because of President Trump's pressure on these countries. And in fact, these companies, they surged last year, but late last year, we saw a brief pullback that was amid signs of some potential progress toward ending the conflict. And we have seen that President Trump has suggested a few times that the war could be resolved in the near future. But so far, we haven't seen any tangible progress despite these months of diplomatic efforts by the Trump administration. So I am curious about your thoughts on what the emergence of any real progress in peace talks could mean for these European defense talks.
I unfortunately am. I don't think. I don't think Russia is motivated. I don't think Putin is motivated to end the war, unfortunately. And I think obviously Ukraine is very motivated to defend their country, and I think they're actually, there's a lot of arguments either way about how Putin's actually winning the war, just on a on attrition basis, I guess. But there are reports that they're losing 30,000 troops a month. Putin's losing 30,000 troops a month, and he's recruiting at 35,000. I mean, those are big numbers, and I think it's less than it's like a 2-to-1 or 2.5-to-1 weight ratio versus Ukraine. And Ukraine's coming out. They've got some great technology, and they're coming out with new weapon systems. Cruise missiles. You've heard about the Flamingo cruise missile, which has much longer range actually than the Tomahawk. And I think they're doing a good job. And I think if they're supported, via NATO, and NATO, spending the amount they appropriately, the countries, the entire, the NATO membership spending appropriately on supporting Ukraine, not just the United States, which has been by far the largest supporter of Ukraine, again, by orders of magnitude. I think if it's supported appropriately by their NATO countries and just nations, you see defense budgets in these countries on a percent of GDP basis is a direct correlation of the amount of they spend on a percent of GDP to their proximity to the border of Ukraine and Russia and Belarus and all that. So I think if these countries are sort of carrying their weight and doing their fair share in supporting Ukraine, I think Ukraine can be able to fend off Russia. But I don't know if that. I'm not sure the long run of that. Maybe, hopefully, there'll be some form of an armistice or a like a 38th parallel type thing where essentially just there'll just be a zone of demilitarization between the two countries, and I think that's probably the long run of that. And I think actually that's not really going to change as far as defense spending, where you've seen these huge increases in production capacity demands, and you've heard what President Trump said about the defense companies, and then at the same time giving out large defense contracts for missile production and rearmament. So I think even if there is some form of a armistice, I think the world is very aware that it's not a safe place, and rearmament and replenishment of inventories are going to be needed. So I think it's going to be continuing to increase defense spending over time. I don't think it's a near term. And on top of that, I think that's still not the biggest, that's not the biggest, the closest alligator. Well, that's not the biggest overall long-term issue, which is, I think, our peer threat, which is China. And I think China is growing their defense base, at essentially twice at ours on a CAGR basis, much higher rate than we are. And I think that's where probably the future, the pivot to the Pacific, what then we've talked about, that's really going to be the focus and the need for, you saw a report the other day about, they're going to be a need for actually double the amount of B-21s and F-47s than originally planned. I think they were talking about maybe 100, next generation bombers, and to deal with China, to really deal with China and the Strait of Taiwan and all that is actually going to be double that. So I think really that's more of the issue long term. So there's a lot of moving parts, but and that's an important one, of course, is Ukraine, but I think there's unfortunately more, even if there is some type of agreement.
Let's talk about the Middle East now. And I saw one of your recent notes, which highlighted a strategic gap in the US naval presence in the Middle East region and the escalating threat from Iran as of early 2026. So, can you talk about the implications of that dynamic for the defense industry?
Yeah, that's another it's another issue. The Middle East. I mean, there's obviously a lot of things going on in the Middle East. Just not. I mean, right now I think American focus is right now looking at Iran with obviously the Abraham Lincoln and the AOR, and having that carrier battle group or carrier strike group there. And but there's obviously other, obviously you've got the whole issue with the Houthis, and you still have Israel and Gaza and the volatility there. But I guess the main event right now is Iran and the negotiation, the discussion, the meeting today in Oman. And again, it sounds like Iran has their heels dug in, and we've heard about the potential atrocities which are not good in Iran. And I don't know if there's they talk about the off ramp, and if it seems difficult, this off ramp seems difficult to get to because of the nuclear discussion, and they're probably not going to want to ease on that, even though I guess they talked about that being the only talking point that they're really thinking about. But Iran, it's a problem, and obviously, with the strike over this past summer on the nuclear facilities, that was obviously I think a positive in a sense that it limited their the potential for them acquiring a nuclear weapon anytime soon. But if they continue down this road, I think it's still going to come into the same problem. They have the leverage they have. They obviously have a lot of, they say, I guess, thousands of short range ballistic missiles, which are problematic because of the time of flight and the difficulty in picking those up. And, just a number, just the amount of, just the overwhelming capacity of that. That's an issue, of course. And then they can do, obviously they can mine the Gulf and the Strait of Hormuz, which also is a big problem. A huge percent of the world's oil supply travels through that strait. So there's some issues there, and it's a large problem. It's it's going to be difficult to see how we resolve this, but they definitely have moved a lot of assets, including THAAD and Patriot missile batteries into the region, and a lot of aviation assets are there. So I think this is probably it might be more imminent than we might think.
Okay, let's talk about defense stocks because these have been on a bit of a roller coaster ride recently, and they surged in 2025, as I had mentioned earlier. So last month, they initially surged after the Venezuela-related news, and then they moved again after President Trump called for a $1.5 trillion defense budget in 2027, which is more than 50% above the budget approved for 2026. Then there was a pullback when Trump posted on social media that he would not allow defense companies to issue dividends or repurchase shares. And then this week, they have sold off with the broader market. So tell us what's going on here. How should investors be interpreting these swings?
Yeah, I think near term, obviously there's people who are going to trade around this industry with the news, the things that you just mentioned, and that's in the industry has gone up a lot. It's been a very big beneficiary of increased defense spending in the last few years. But I think over the long term, I think it probably these near term dynamics don't really matter as much. I think the long term is the need for, and again, just make everything relative and put into perspective. The U.S. spends around about almost 3.5% of its GDP, a little like 3.2% of its GDP on defense. Historically, post World War II, throughout the Cold War period, into present, it's including all that on average, has spent more about 6 to 7% of its GDP. Using that metric, using another metric, using federal budget. Again, we currently spend around 15%, let's say, of our federal budget goes into defense spending. Over the long term, post World War II, it was more in the mid-20s, somewhere in the mid-20%. So the U.S. Just on a relative basis, post World War II, we have really underspent, and in defense spending is a form of, for a sovereign country, it's a form of capex. It should be really treated that way. You sort of need to maintain it. You need to grow it. You need to you need to improve it. There's a personnel part of the business, and it's just it's something that I think the U.S. I think the U.S. has probably been realizing it for a while, but I think a lot of the world, post February of 2022, and then October of 2024, I think realized that the world's not safe, and then on top of that, like we talked about, China positioning for discussion about Taiwan and how it's operating around the Spratly Islands, and I think those dynamics all play in to people, I think, realize that the peace dividend is truly over. The days of NATO and other allied countries essentially underspending, which they have been doing. And I think the number they put out the other week, the Treasury Secretary, since 1980, the U.S. has outspent the rest of NATO by over $9 trillion, and that number is actually, I looked that number up, and it's pretty in line. It's close to that number. It's a pretty good number. So I think the world needs to spend more, and the reality is that the U.S. is by far and away the most dominant defense, has the largest defense industrial base by far, and the highest technology. And it's going to be hard for other countries to catch up, is the reality. And so I think global defense overall is going to continue to probably increase for a number of years, and the U.S. defense industrial base is probably going to be a big beneficiary of that. So as far as U.S. defense companies selling off because of a tweet, which listen, I think these companies, they want to see orders too. I mean, building a plant for a missile factory plant is not a speculative play. It's not like buying a house in a high zip code, high value zip code, and trying to flip it. It's just not, that's not the business. It's very long, 30+ year programs, and you need contracts. You need something you can bid on and win that bid, and then be able to produce. So I think it's a chicken and the egg kind of thing there a little bit. And I think when you start seeing these contracts, more and more, which you've already seen a bunch of, by the way, with Lockheed and Raytheon, you've seen a bunch of awards already given, L3Harris. You're going to probably see more, capex. You're going to see these companies putting out press releases about partnerships and growth. So I think in the long term, it's going to work out overall.
So some of the major players, including some of the names that you mentioned just now, so they reported their earnings recently. I saw from Boeing, Lockheed Martin, RTX, Northrop Grumman. Was there anything in those results that really stood out to you?
I mean, I just think the demand signals that they were projecting were pretty apparent, and the amount of growth and backlog that we're seeing. They either have continue to have record backlogs or near record backlogs. Essentially, almost all the companies that I've their earnings calls this quarter that I've listened to, and it's just these backlogs are huge. We were talking about quadrupling and tripling, quadrupling of production. There's just not a lot of industries that have those types of, I mean, except for maybe AI chips. There's a very few industries that talk about that kind of demand. So I just think they're in a pretty good spot right now as far as what the demand signal is, and it's a good problem to have. I mean, the supply chain has some near-term dynamics and challenges, particularly on engines, is a large engines, and then rocket motors being probably the longest poles in the tent. But those will work out. They're going to build additional capacity, and those eventually will become not as much of an issue. But that is even the most of the discussions have been incremental improvement in supply chain. So I think it's overall on a good path, I'd say.
So the world is unfortunately becoming a more dangerous place, as you also mentioned earlier. So in addition to Russia-Ukraine war, there are rising tensions between China and Taiwan, India and Pakistan, and then continued conflicts across the Middle East region. So with that backdrop, I'd love to get your thoughts on the outlook for the industry in 2026, especially after the surge that we saw in 2025, and also talk a little bit about your ETF, GCAD.
Our GCAD, we were talking before we began, we talked about companies that have growth with cash flow and have good valuation. So we like looking at some of these companies that maybe haven't been fully realized, the market hasn't fully realized the value of what they can do. And we have a small company called Albany International. It's an aerospace and defense supplier, but it also has another business which does an industrial paper pulp machine clothing business, which essentially makes the belts for these manufacturers of cardboard. And it's a great little business. It's got high aftermarket piece to it, high margin, but relatively low growth. But they use that technology in making these belts, making these machine clothing belts. They use that as a 3D weave, and they use that making carbon fiber 3D weave. And they can make fan blades for engines, for aircraft engines, and other parts as well. They can use it essentially to replace most of things that are titanium that don't need to be in high temperature environments. You can replace with this 3D woven composite carbon fiber. So they have this really good business that's growing. Is still small, and we think that eventually, and they're doing a couple other things right now. They're spinning one of their businesses that was contractually limited and looking to sell that, and that will be probably a catalyst in the near term. And in the longer term, they'll hopefully spin these two businesses off, and it trades around the high 50s, and it could be over $100 if they were to do this. So there are still some, I know the industry's run up quite a bit, but there's some good companies out there that have a lot of growth potential, and they have great businesses. They make very specialized sole source parts, and it's a beautiful business because it's highly regulated. It goes on critical components that can't fail. And they're usually the dominant operator, whichever piece of business they make, they're usually the dominant one. So we like companies like that. That's one of ours in our GCAD ticker portfolio. And I'd say for 2026, it's probably going to be somewhat more of the same. We'll see. It depends. We'll see how. It's run up again. Like I've said, it's run up quite a bit over the last couple of years, but the demand signal's there, and you're just seeing a lot of growth in orders. Backlogs are increasing, and so you're probably gonna have another good year in 2026, is my guess.
Awesome. We'll have to leave it there, Tony, but thank you so much for joining us today and for sharing your insights.
Thanks so much, Nina.
That was Tony Bancroft of Gabelli and Portfolio Manager of the Gabelli Commercial Aerospace and Defense ETF, ticker symbol GCAD, GCAD. There are other defense and aerospace and defense ETFs that are worth a look if you want. So the largest one in the space is by iShares, the iShares US Aerospace and Defense ETF, ticker symbol ITA. It is very top heavy. So if you want to avoid a lot of concentration in a few names, then State Street has an equal weighted ETF, S&P Aerospace and Defense ETF, ticker symbol XAR. If you want to focus on the European aerospace and defense stocks, then there's an ETF, EUAD, that is by stocks. And then there's an ETF by Global X that focuses on defense tech companies. The ticker symbol is SHIELD, SHLD. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zax.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.